Welcome to The Enterprising Investor, the flagship podcast for the CFA Institute. My name is Lotta Moberg, and I am sitting in today for Mike Wahlberg. And we are actually talking to you live from the CFA Institute annual conference. Today with me is Mark Higgins. Welcome, Mark.
Thank you. Thank you for having me, Lotta.
And we had a panel today on a private credit where Mark was talking and was very well attended and very well appreciated. This was recorded for the Financial Thought Exchange. This is the podcast for the CFA Institute Research Foundation. That is where you normally will find me. So if you want more content from me and my colleague and friend Larry Siegel, check us out at the Financial Thought Exchange on YouTube and everywhere else where you listen to podcasts. So I thought we should talk a little bit today about you and also the content of today's panel and other things that people might want to hear about private credit here. So just first, as a short introduction, Mark Higgins is a Senior Vice President for IFA Institutional, where he provides advisory services to a variety of large institutions and select high net worth individuals. He has more than 14 years of experience advising both small and multi-billion plans. As a financial historian, Mark has actually written a book, which is very popular here at the conference, actually. It is called Investing in U.S. Financial History, Understanding the Past to Forecast the Future. So you can rewind that now and write it down, as well as his name, Mark Higgins, and you'll find it anywhere that you would buy a book. He also serves as a member of the Museum of American Finance Editorial Board. So very much the financial historian provides a different perspective where we are in...
It does. It provides a valuable perspective because the more you extend your memory by essentially absorbing the memories of our predecessors, the more you see the same things happen over and over again. And private credit is different in some ways, but in a lot of ways, it's following the same trajectory as we've seen with other alternative asset classes.
Yeah, we're definitely, it's the interest of anyone in finance, right? You're not repeat the mistakes in the past and not always having to make the same mistakes in the past. Yeah. So we had the panel, your remarks were very appreciated and maybe a little bit surprising because I think that people took them to be a little bit, if not negative, but skeptical on the sector. So what would you say would be the main things that you hope that people in the panel took away from the remarks?
I mean, this is something you definitely see in history is the most successful investors are skeptical, that you have to be, because one mistake can really pretty much ruin a lot of things that you get right. And so, I was negative in the sense that if you look at the asset flows into private credit, I mean, they have accelerated substantially, and that is consistent with what we saw with venture capital in the 1980s and 1990s after they had a fantastic period of performance. Same with buyout funds, same with hedge funds in the late 1990s. We saw it with whaling in the late 1800s. So the main message here is, just like any asset class, I'm sure there are opportunities, but it's not a free lunch. And if you just bluntly allocate to private credit and, just rely on, pretty generic recommendations from consultants and staff, it's probably not a good time to get it in. There's a very good likelihood, in my opinion, that it's a bad time to get in.
And I think it's an important point that you made, that it's a little bit of a straw man to say that you claim that it's a bubble, and if you can argue against that it's a bubble, it's all fine. Like, that's not what you're saying. You're saying it's a cycle.
Yeah, and you're in a late phase of a cycle that we've seen before. And I believe we're in a late phase of a cycle that we've seen before. And that's the time when it's not enough to be average. You have to be much better than average. And I've definitely seen this repeatedly in history too, is there's a tendency for people to be overly confident that they're automatically way above average when they're not. And so my message was really, if there's a screw on intensifying your caution, turn the screw right now, because it is time to be very cautious. Yeah.
Would people have a tendency to think that they're above average more likely in a sector like this than in public markets? What I'm thinking about is, we all know that public equities and public bond is something that's been around for a long time. So you have to be top notch. And people still think of private space as something where you can come in as kind of from the sideline and take some shortcuts.
I think it's less about them thinking about their that they're above average and more about them thinking that it's okay to be average. That, they're getting a lot of the large public pension plans, endowments. Now it's getting into private wealth. They're allocating to these based on like an average return assumption. And if once a history shows that once an asset class becomes flooded with capital, and I would argue private credit is squarely there, it's not, average is not going to be acceptable. You need to be consistent. You call it roughly. I mean, there's no exact metric, but call it roughly consistently top quartile. And if you're not, you shouldn't be there. And it's less about, are you better than average? Well, it is about it in the sense that you shouldn't be in it unless you're way above average. But it's less about people being overly confident and just not even thinking that it's necessary is what I see more often.
No, it is a pretty broad universe. Are there pockets where there would be opportunities? We on the panel, we slice and dice a little bit. The other speaker did about mid-market, smaller companies and all that, and maybe specific sectors. Are there still opportunities out there, or is it best to analyze this as more the
I'm sure, and that's where I think people were thinking I was overly negative. I'm sure there are, just like there are in venture capital. If you're in a top venture capital firm, it's just that on average, it's not. In my opinion, on average, it's not a good opportunity. But if you're highly skilled, you can maintain that skill for a long time, like Yale University, and what they have done over the past 40 years. Yeah, I'm sure there are opportunities. It's just that it's hard. It's harder than people think.
Right.
Yeah.
And you talk also about, you touched on a little bit, maybe we can talk a little bit more about the role of consultants in this world. You seem to be quite skeptical of their way of doing things. Maybe you can elaborate a little bit.
Well, the issue, and I wrote about this in a paper with the CFA, with the enterprising investors, probably about a year ago, I guess, maybe a little less than a year ago. And, so if you understand the history of consultants, you can kind of see how this happened. They started as performance reporters. And what they did is most institutions were managed by asset management departments at banks. The consultants, basically with their performance reports, show that they're not really doing a good job for a lot of money. So they started moving them out. And to do that, they started offering asset allocation advice and investment manager search advice. But, their background was not really in that. And as time went on and on, they kept expanding their businesses by using that as the base of their value proposition. And there's a lot of evidence that it is causing large institutions, to over-diversify their portfolios in expensive asset classes, get into asset classes that they don't belong in, and overuse active strategies. And if you look at the massive increase in alternatives and this came from David Swensen, after David Swenson's book came out in 2000, consultants are encouraging it. And the funny thing is sometimes I just do back of the envelope math, and it's like the largest 10 consulting firms have literally tens of trillions under advisement. Like, how it's not even mathematically possible for them to add value in aggregate if they have tens of $trillions. I mean, it's just basic back of the envelope math, So the question is whether you're going to get lucky and they're going to, you're going to outperform. But on average, I don't see how it's mathematically possible for them to add value by doing anything but index.
And just to pile on a little bit of the skepticism about consultants here, we're not saying that the asset managers feel like they're just not smart enough and the consultants are. It's a way to divert blame if something goes wrong, because you can say, well, the consultant said it was fine.
Yeah.
Right. So that kind of gives
that does give, I don't know the extent to that's probably unspoken stuff in the back of a trustee's mind. But yeah, there is an element of that. If they are doing what supposedly a professional organization recommended, that probably gives them some legal cover. I mean, I'm not a lawyer, but my guess is that does go into a lot of thinking.
I've certainly seen it in the asset management world where a consultant steps in. Often their analysis is based on what's your performance the last 3 years. So if you if you fail that test, then you're out. And
by the way, 3 years is not only is it not a long time, it exposes you to the problem of it may very well have just been a blip. It probably was. Well, I shouldn't say probably. You have to look at the situation, but there's a good chance it was a blip. And by the time they hire that manager, they're going to go the other way. And there's actually studies done on this where that does happen. They look at hire-fire decisions of institutional investors, and the performance I forget the exact time period, maybe 5 or 10 years before, is much higher than after on average, because they're buying at the top and selling at the bottom.
Right. Now, private credit used to be just called private placement, right? Like lending to non-public companies has been around for ages.
That's what J. Pierpont Morgan did 100 years ago.
And it's also origin of finance generally in terms of just, credit provision. Now, obviously we're living in a different world now, but how is it different now that we call it private credit, and we have this label on it, there are more funds out there?
I think the main difference is that everyone's allocating to it. I mean, it's caught on as a trend. I think that's the main difference. And, I talked about this in the presentation. It is the typical alternative asset class cycle where you have a void that opens up, a legitimate void that opens up in the market. So venture capital became a need because the banks were skittish they're still skittish after the Great Depression because, 30% of them failed. And there were a lot of post-World War II technologies that could be commercialized. So that gave birth to the venture capital industry. But, over time, it gets over-allocated, and only the very, very strong and top funds add value. And that's where we are today. And I see private credit following that same cycle. There was a legitimate void that opened after the global financial crisis because all the banks, it's actually kind of similar to what happened with venture capital, because the banks, just like they did after the Great Depression, they were forced to pull back and rebuild their reserves and become more conservative. And this opened up now. And this question came up from the audience. I strongly suspect, based on just, the signs around, that supply of capital far exceeds the demand for attractive enough opportunities. But that's what happens in the late phase. Like, everyone follows the early adopters, and you just get too much capital chasing too little supply. And I think that's where we are right now.
Right. And for people reading your book, how much private credit is there in there? Do you put that? How would you describe that?
I do. I actually don't remember, to be honest with you, but I probably mentioned it when I talked about alternative asset classes. I have written a paper for the Enterprising Investor on private credit. I mention it in a paper that I wrote for Financial History magazine on the alternative, what we're talking about, the alternative asset class cycle. It's called, you can Google it. It's free. It's called a 45-year flood. And it describes the cycle we're talking about. But so I mention it, but it's really the last couple of years that I finished the book 2 years ago. So it's really accelerated.
But it certainly has its place, right, in financial history, as like these cycles and all that. You can fit in there.
Again, like that's usually how these cycles start, is there's a void that appears in the market that's legitimate. It's just that human instinct is everyone starts, it's like the last watering hole, and pretty soon it goes dry. Or it's not dry. Like, if you're 3 rows back, you're not going to be able to, take advantage of the watering hole.
So I'm interested in how you think about the professionalization, I'd say, of finance generally. I do know that you mentioned an article of yours about how modern portfolio theory, I would say, is a contribution, but also can be overused or misused. Maybe you can give a little bit of flavor on that.
The problem with this is a little generalization, but the problem with modern portfolio theory is a lot of institutions. I'm a little less familiar with how this plays out with individual investors, but with large institutions, what consultants mainly consultants, staff to some degree, will create assumptions for 20, 30 asset classes, some of which don't have nearly enough history to create a reliable assumption. And they create these models where it just takes the expected return, the expected risk, and the inner asset correlation, and shows what is a supposedly optimal portfolio, but the underlying assumptions on those asset classes are very unreliable. And number two, a lot of these asset classes require skill. Like like we were talking about with private credit. If you're not skilled, I don't care what the optimizer says. It doesn't matter. And there's so much over-reliance on that, on MPT in areas that are just well beyond the margin of error. And it causes people to neglect. At the end of the presentation, I emphasized to everybody, like, demand track records, and do your due diligence if you're going to enter the space. Because if someone just tells you allocate to it based on an assumption, that is not enough. And that's really the problem I see with mean variance optimization in modern portfolio theory.
And it's certainly also the issue of converting what you see in the historical data to those forward-looking assumptions, because the assumption is a forward-looking statement.
I mean, we looked at private credit. So there's a I won't name the consulting firm, but there was a consulting firm that was assuming over 20 years, real, like net of inflation, like a 6.5, I think it's slightly below a 6.5% real return for 20 years compounded for private credit. That's really aggressive. It seems pretty out there. And if people are allocating on that, based on that, without any evidence of skill, good luck.
What do you think the audience here, hearing you talk, hearing some other views, is there a little bit of more caution now, skepticism among the more like professionals that we have here at the conference? Or
I hope so. I mean, I think that I'm actually very complimentary of the CFA. There are places that, I'm not welcome because, what I'm saying is not in the interest of a lot of people, but the CFA has been very balanced. And I think that everybody benefited from that session, from hearing from an asset manager who is more bullish on this sector and somebody who's skeptical. And, they're going to make a better, regardless of which way they go, I hope they make a better decision because they heard both sides.
Yeah, absolutely. So thank you so much for tuning in. This has been an episode of The Enterprise Investor. You usually find me at the Financial Thought Exchange podcast, that is of the Research Foundation. This is broadcasting from the CFA Institute annual conference. Thank you for tuning in. Thank you, Mark.
Thank you so much, Lotta.